Good day and welcome to our latest finance industry event at the UTS Business School on today's somewhat sunny Friday afternoon. I'm looking out of my window. It is 12:15 p.m., just after noon. My name is Gerhard Hambusch, and on behalf of the Finance Department at the UTS Business School here in Sydney, Australia, we'd like to provide a warm welcome to the audience and our panel guests. Thank you for joining. We're excited to have you. We're excited to have 4 financial experts today on the panel, including guests that are zooming in from the United States, and to be precise, from the Chicago area, also from Melbourne, and also right here from Sydney. Thank you very much for joining us today. I would like to ask our panel experts to briefly introduce themselves. And if you like, you could also share any fun fact about you that you're willing to share. Jeremy, if I can ask you maybe to introduce yourself first.
My name is Jeremy Heer. I work for the University of Chicago. I help run their endowment. Our office is responsible for almost 19 billion total, 10 in the endowment, some pensions, some other endowment pools, some money for the hospital, things like that. Fun facts about me. I'm a bit of a musician, and I play about 8 different instruments. So, and more that I try to play sometimes, but I'm not very good at the other ones. So.
And Jeremy, you want to share your YouTube code sign for people to find you and see your hundreds of videos?
All you gotta do is look for my name. There are a lot of Jeremy Heers out there, so I'm easy to find.
Thank you. Appreciate that. Shayna, if I can ask you to introduce yourself, please.
Hi, my name is Shayna Sissel. I am the Chief Investment Officer with Spotlight Asset Group. We're a registered investment advisor located just outside of Chicago. We have about 600 million in assets under management as of today. And we deal primarily with high net worth and ultra high net worth individuals and families. Fun fact about myself is I am a dual citizen. I obviously am American. I was born here in the United States. I'm actually originally from the Boston area, but I also hold Irish citizenship because my mother was born in Killarney, Ireland, and she grew up there before coming to the United States when she was about 10. So.
Brilliant. So you have choices regarding your residency or place to live and work.
It also makes traveling in the European Union a lot easier.
Brilliant. And I may add that you're very active in the media in the United States, and you have your own podcast series, or at least one of them is called The Black Swans, promoting females in finance. So I'm encouraging our audience to look you up on the web too. Thank you. Carrie, if I may ask you to introduce yourself as well in Melbourne.
Sure. Thank you, Gerard, and good afternoon, everyone. Thank you for joining us today. My name is Kerry Craig. I'm a market strategist within JP Morgan Asset Management, the asset management arm of the business. Been here for about 10 years, 5 in Australia, and then the rest of the time I was over in London. The basis of my job is to really talk to institutions and financial advisors about what's happening in markets, and hopefully try and make them less complex than they actually are. So hopefully can add some value today. I'm looking forward to the end of this call, not for the end of the discussion, because I want to watch the America's Cup race, which is currently happening in Auckland, New Zealand, which is where I'm actually from.
Thanks very much, Kerry. And last but not least is my colleague, Thales Putnens, who's here in Sydney, Australia, in the office.
Hi, everyone. My name is Thales Putnens, and I'm a professor of finance here at the UTS Business School. My research areas in which I specialize are financial markets, and in particular looking at questions like market manipulation, short selling, high frequency trading, dark pools of liquidity, and cryptocurrency markets as well. A quick fun fact about myself: when I'm not working or spending time with the family, I like to brew beer.
Wow, that's certainly something that I sometimes enjoy as an activity, and I wish I could do the same, Thales. So thanks for joining us all. Allow me to quickly set the scene. So today we want to chat about interesting events involving Reddit, Robinhood, and GameStop, to name just a few. And the bigger picture pertaining to these organizations or institutions is the democratization of finance, which generally refers to the gradual process of removing control of the financial industry away from select few large financial institutions and distributing the power among members of the general public. And these developments are, of course, fueled by, for example, advances in technology and include well-known novel financial realities such as crowdfunding or peer-to-peer lending. Of course, the financial democracy revolution is embodied in the newly emerged fintech industry, where companies operate at the cross-section of finance and technology to make what they say our financial lives, effortless. But of course, with the increase in ease of service provision and consumption, it comes the disruption and change with impacts on, for example, consumers and investors. So today we want to shed light on the empowerment of retail investors that have gained easy access to financial markets and allegedly trade securities at zero costs. Now that's effortless, isn't it? As you know, a widely discussed and related case recently made headline news and pertains to US-based video game retailer GameStop, also referred to as GME, using the company's NYSE ticker symbol. And since all this happened in the land of the free, which is just a short 15 + 4 or so flight hours away from Sydney, we thought it would be very beneficial to invite US-based finance experts to help us understand what's going on. So I'm starting with Shana and Jeremy, and I'm probably throwing the question right at you, Jeremy and Shana. What happened to GME, also known as GameStop? Perhaps you could roughly break down the story for us.
I love how Jeremy decides that I'm going to be the one to do it. Quite simply, an online forum called Reddit has a finance forum called Wall Street Bets, where a great number of people, I have no idea the exact number, go on and share ideas. Somebody on this forum noticed that there was a very large short position in GameStop, and decided to use the power of the group to execute a short squeeze, which isn't all that uncommon. That happens when securities have high short interest, because if you can push the stock price up, you force whoever's short to have to eventually cover, because they don't have infinite amounts of cash, and so at some point in time they have to cover the risk. Their prime broker and their brokerage firm makes them. So that was the point, is to force these shorts out of the stock. And when the shorts cover, the stock price goes up because they have to buy back the stock. So they attempted to execute this. It was extremely public knowledge. Everybody was sort of aware of what was going on and who the key players were. And most of the folks who decided to execute this particular plan were executing it through Robinhood, a newer player in the world of retail brokerage. And they were typically doing it through their Robinhood accounts, which are cheap, no-cost accounts, which don't require much to open. And Robinhood had attracted younger investors by offering them the ability to open accounts with smaller minimums, cheap cost, no commissions for trading, and then they also offered them a free stock every time somebody opened an account. And ironically enough, some people actually got GME as their free stock. I actually know some people that did. So that's sort of, in summary, what happened. It created an incredible move of the stock going from $2 to $400 at one point. And it led to all sorts of additional events occurring in the markets that have resulted in people asking questions of what led to restricted trading, Robinhood closing out positions, and so on and so forth.
Great, Shana, thank you so much. And I'll put the chart on the plate here. Maybe, Jeremy, you can jump in and tell us a bit about the technicalities around it. We talked about short selling, short squeezes and stuff. What happened? Sure.
Well, the other part of the story that I would, Shana did a great job explaining the basic short squeeze concept, and she's exactly right. That's the basics of what happened. Something that amplified it is the fact that a lot of these retail traders, these new guys, they're all going in and buying call options, right? And so when you buy call options, someone's got to sell those options to you, then an options market maker, if you will. And the people who are selling these options to I think we probably need to qualify this, because it's not just the retail people that are doing this. People buying call options. If you're buying options, normally someone is selling them to you. If someone's entering into an option position, and if you happen to be a market maker that does this, you're a liquidity provider, what you're going to do is you're going to go and delta hedge your position. Now, so if a bunch of Robinhood guys come to me and I'm a market maker, I'm selling calls to them, then I'm going out and I'm buying stock to hedge my position, right, in delta equivalent. Well, then the short squeeze happens, the market goes up, and the delta of my positions increases. So what do I have to do? I have to buy more stock and on it goes. And so I think that this is I know that those of us who are kind of active on the financial Twitter world have all seen the stories about this. It's really kind of well discussed. The whole gamma squeeze concept, that's what this is called, because gamma, rate of change of your delta, it really played a big part in this. It really amplified the moves. That's why you get these massive, massive changes. I also think that characterizing it as just a retail phenomenon is, I think there's probably, it wasn't retail versus hedge funds. There was retail at the beginning, and then there were hedge funds on both sides of that. There's no question in my mind. And we should probably get into the whole payment for order flow concept with this too, because that plays into this without a doubt.
Thanks very much, Jeremy. And it seems like that you mentioned several drivers, several players on the field. I put here just the charts that I copied from the web, and also one that was sent to me by Thales here, the intraday volatility of GameStop on Wednesday. Thales, if you want to jump in a bit to talk or to walk us through a bit about, for example, intraday volatility here, which seems to be still on. When we designed this event 3 weeks ago, we thought by the time we talk about it, it's over, but we're still fully on there, and all of the guests have confirmed that in their pre-chats with me. Thales.
Yeah, it's amazing. When we were planning the event, was around the time that GameStop had hit that $400 mark. And it looked like maybe from that point it was just downward and this story would die, but it certainly hasn't died. It certainly hasn't gone away. So GameStop even yesterday was up, trading in the $300s, $300 that is a share intraday, close to where it was at the height of the action back in late January, early February. And yesterday's trading was particularly volatile for GME or GameStop. And the chart that Gerhard is showing is the intraday fall of the price, where it dropped something in the order of 40% within the space of 25 minutes. And when stocks move that quickly in modern US equity markets, they trigger so-called circuit breakers that stop the market, stop the trading in the stock, allow the market for a bit of a timeout, let the market cool down, reassess what's going on, and then restart, resume trading. So that happened on the way down yesterday. So it's certainly, the action hasn't gone away yet.
So Thales, given this turmoil in markets that some watch with concern, given that markets need to be preserved or their functioning needs to be well preserved, is short selling in general a bad thing if that's behind this? And Jeremy introduced us to other drivers as well, but I want to get this short selling, good, bad or ugly out of the way first. Maybe some of you could comment on that. Is short selling something that needs to be forbidden, needs to be maintained, needs to be protected?
So short selling plays a fairly important role in markets. When a stock becomes overpriced, when the price rises above what the stock is actually worth in terms of the fundamentals of the company, that's where short sellers have the opportunity to come in and trade against that stock by short selling it if they don't own the stock already. They borrow the stock, sell it at that inflated price, hoping that the price will return back down towards fundamentals and they can cover the short positions at a profit. So short selling, that's one example of how short selling plays an important role in markets to prevent prices from becoming overly inflated. The other important roles are market makers, that are liquidity providers, are often using short sales to take the other side of a trade. So if someone comes to buy a stock from a market maker and they don't hold that stock, they short sell it to be able to provide liquidity to buyers. They also play a role in hedging positions. So the problem here is that as short selling becomes riskier and riskier to sophisticated market players because of events like GameStop and Redditors banding together to gang up on short sellers, then short sellers are going to be reluctant to take those positions, or at least disclose or trade in such a way that their positions get disclosed. And that makes it difficult for the market to correct overpricings in markets. So potentially you could see a decline in market efficiency, that is the accuracy of prices going forward, as short selling becomes riskier and hedge funds and other sophisticated players become more reluctant to use short positions.
I want to jump in here. I'm a huge defender of short investors because they are such an important component to price discovery in the market. Short sellers are also incredibly important in being able to discover and uncover fraud. Even when short sellers aren't successful in their shorting, oftentimes just being short can force companies to make changes that are better for long investors and for employees. Another really important component they have is they create bottoms in the market. So this happened in the financial crisis. When you have short sellers, they don't short to zero. They will eventually cover their position at some point. So they actually create market bottoms, and they can make sure that you don't have these violent drops in a market. You know, when you think about GME, if there's not a lot of short sellers in GameStop right now, and as far as we know that's the case, there is only about 25% short interest today versus 110, you know, at the peak of the insanity with GME. There's no motivation to buy the stock to create a bottom, and so in the financial crisis, there was regulators decided that you couldn't short financial companies, which actually caused financial companies to fall more than they probably would have had short selling been permitted, or short sellers being able to hold those positions because they would have created the bottom for those. So they're really important components. And for markets to run efficiently, you have to have people who buy and sell risk, and short sellers are buyers of risk when people are selling risk. So, you know, that's a really important component to markets working efficiently.
Thank you, Shana. And I'd like to talk more about risks and markets in a minute by querying Carrie in particular to start with. But before we get there, there's just two broader questions before we get into those details. And those questions have popped up in forums that Jeremy and I are part of, you know, people that in North America, that I'm part of a group there. We've discussed in a chat this event. And the question came up, is this a case of market manipulation, which, for example, according to some professional standards or to some legal codes, may be the intent to push, for example, the price of a security upwards? So I'm asking my experts here, what is your view on the unfolding of these events and the eventual the reaction of the price, of course, with a steep rise? Was this something that could be playing in the bucket of market manipulation? Yes or no? I'm just interested, as we had some questions.
It's a gray area. So I think, broadly speaking, short squeezes and the Reddit forum working based on fundamental analysis that was originally presented to execute a short squeeze is not market manipulation, in my opinion. However, it has come to the attention that sort of the ringleader of Reddit, this Raging Kitty or whatever, was a financial advisor in my home city of Boston, who is a CFA. And as a result, for him, there was some ethical issues there in that the ethical standards of the CFA, if you're licensed by FINRA with a Series 7, you have ethical requirements. I have the CAIA designation. There's an ethics component to be able to maintain your licenses and maintain your position. And one of the things is that you're not allowed to not disclose that you're not a financial advisor. You're not allowed to hide the fact if you own a stock. You're not allowed to manipulate crowds to execute your own gain. So on an individual level, for many of the players that were involved in this Reddit GameStop scheme, there were ethical issues, but the actual idea of the short squeeze and to have a group of people do what they were doing is, in my, that's a risk you take when you're in the markets. And if you're short a position, that's a risk that you're aware could happen. But it's the individuals themselves that had some ethical problems with what they were doing and will likely lose their designations and their licenses and their ability to work in the field in the future, if not go to jail. But I don't think that's going to happen. But there is likelihood that the CFA will be removed or some sort of fines will be given to those who violated the ethics of their particular frameworks.
Yeah, I would just jump in and agree with Shana completely. The gray area is a perfect description of this. There's a lot of things in the markets that you could think of as market manipulation, right? I mean, the words are kind of made to elicit a specific outcome. People trying to take advantage of technical, like liquidity problems in the market. That's really what we're talking about here, right? We're talking about a technical thing. There was a ton of short interest and not a lot of float. You can't really take advantage. You can't call that manipulation. You're trying to gain an edge. I don't know that I would call it that. That's just my opinion. I don't think you can. I don't think you can control something like that without taking away the ability of market participants to disagree about the true value of stock, and that's what price discovery is all about.
Thales, I know that you are familiar with regulators and their work, and you're a market expert. And then we move on to the risks with Carey too, of course. What is your view on this market manipulation topic? I'm just interested.
Sure. So there were a mix of motivations for why people were trading GameStop. And some of them are perfectly legitimate. So when someone feels that the stock is undervalued and puts out some fundamental analysis and tells their friends why they think it's a good buy, there's nothing wrong with that. That's legitimate trading. Where trading behavior crosses over into market manipulation from a legal perspective is either when you're making false disclosures, when you're deliberately disseminating false information to try and induce others to trade or to push a price, or when you're trading for the purpose of influencing a price or triggering some sort of an action. So the intention is very important when it comes to market manipulation. And so those people that are putting out fundamental analysis and saying, I love this stock, I'm buying it for these reasons, I'm long, here's my position, nothing wrong with that. The point where it crosses the line is where you say, let's push this thing up so high that we're going to trigger a short squeeze and force others to have to close out their positions, and that'll make us a huge amount of money, etc. That's where it crosses the line. And so if you troll through the Reddit post, you'll find that there's two types of people that are in there. Those that are talking about the squeeze and trying to push for a squeeze and talking about let's pump this thing. And those that are legitimately saying, we love this stock, we think it's really a good buy.
Thank you, Thales. And I appreciate all of your views regarding this topic. As you know, the UTS Business School is committed to exploring topics that relate to finance and also ethics in finance. And so this was something that was a strong personal interest of mine too. And we had audience questions to that too. And we have more questions that we come to later. Carey, when we had a quick prep talk together, you said, that perhaps the risks to markets and investors is something that a question that you've been encountered with your clients at your firm. Maybe I can just ask you the question similar to the bullet point on the event sheet. What kind of risks are there to markets and investors? I assume that your clients have perhaps approached you and you're facing this kind of question on a daily basis.
No, that's absolutely right. And I think that the risks are really, coming from where you stand on this. I mean, there's always a case of buyer beware if you're thinking about the risks to the individual investors who are using these platforms to buy stock like GameStop. And when they actually come in on that purchase, how late in the trade they are, the earlier ones always gain the most. So I always feel there's a definite case of buyer beware. The risks that we talk about with our clients are more about, what does this mean for the market as a whole? Does it generate lots of volatility? What does this mean for hedge funds and performance? Are they going to be winners or losers of this? And is this actually going to be focused of more regulatory scrutiny in the US and around the world, and will eventually bring it to an end? So I think it's important to realize that the risk is that there are going to be opportunities created by it as well. I mean, there is going to be increased regulation around this. There is also going to be increased retail activity because this isn't a phenomenon that's going away. The driving forces of why we're seeing more retail investors is a cause of what regulation has done in the past by bringing back the change around allowing sort of non-bank participants in the market. And also the fact that we have demographic arguments, younger people who want to be involved in investing, and easier communication through social media, Twitter, Reddit, whatever you want to talk about. So it does increase volatility. It does bring that risks, but it also means that you are going to have to think about how to account for that in portfolios. More volatility is actually good for hedge funds and how they behave in the market creates relative value opportunities. The risk around, is this a broad market phenomenon? No, most of the stocks are focused on things that people are very familiar with, maybe consumer brands, and are quite narrow in terms of where it's actually focused. So it's not going to have the biggest impact. I think it's more around how it's tracked and how you actually sort of contain or at least follow retail flows and where it's going to impact the market more than anything else. So the risks are quite broad-based, but I don't think they're going to be systemic. And it's really the regulatory pushback, which I think will be the biggest thing to look at.
Thank you, Kerry. And maybe, Jeremy, I can bring you in the game here. You're my institutional voice. What kind of risks from an institutional investor perspective do you see, or probably are there any? Is there big harm to be expected?
Well, it's interesting. The kind of exposures to this sort of thing, most of us institutional investors on the endowment, foundation, pension, family office side, family offices maybe a little less so, we don't really do that much directly in individual stocks. The way that this would tend to affect one of us, we tend to do portfolios of managers, portfolios of funds. And so the way that this would affect us directly would be if we, say I happen to be in Gabe Plotkin's fund, right? Then that would be the kind of thing where I would feel it. But as far as having positions in GameStop or in other similar meme stocks or thinly traded stocks, that is kind of a decision that we really tend to leave up to the managers that we hire. They're the ones who understand the space, who have the expertise to really understand it well enough to trade it. We don't really trade. We're, buy and hold kind of investors is what we do. We tend to be very long term, tend to be sticky money most of the time. And so something like this is really something we like to know about. We want to know about market conditions, and we want to know whether our managers have the skill to work around or to possibly take advantage of such things. But as far as directly affecting us, less so.
Thank you, Jeremy.
Sure.
And Shana, maybe you have a chance to shed some light on those investors that are not, similar to what Jeremy just alluded to, are not directly invested in GameStop or other meme stocks, but that hold those stocks via ETFs or other means in their portfolios. Given that you work with private investors, can you tell us a bit about your view on that, please?
So the concerns that a firm like mine, who deals with individual investors, ultra high net worth and high net worth, is just, my biggest concern throughout the entire process was what if any overreaction from the regulators is going to occur, right? Because even though my clients are not necessarily the Reddit crowd, any regulatory changes that occur that impact individual investors' ability to trade is going to impact my firm and my clients, because we do interact with individual stocks. So the biggest concern I've had through the entire process was the system actually worked exactly as it was supposed to in terms of the regulatory backstops to keep things from getting too out of control, so that we had a massive liquidity issue across the entire market. And we can get into what that means in terms of why Robinhood, suspended trading and limited trading in the stocks and certain stocks, and why Robinhood did it and not, say, Fidelity or Schwab. We can absolutely get into that. But the bigger concern is, will the regulators overreact and then put even bigger frameworks into it, which would actually result in an even more significant response that would be even worse for retail investors in an effort to, quote unquote, protect them. At some point in time, you have to decide, people make their own decisions and they have the decision to take the risk or not. And we can only do so much to educate them. And in this particular case, folks like myself were screaming like, guys, what are you doing? So that's obviously a concern, and you want to make sure that people have the ability to take these risks, and that there's a framework there to protect the overall market conditions. So that's from my perspective, the biggest concerns and the biggest risks that I had, and then just the colossal misunderstanding of how things work, and how this was almost like an education to the retail investors of things that professionals like myself and like Jeremy and Kerry and Talis are all aware of, certain regulatory frameworks and why, things occur the way they do. But a lot of other people didn't understand or didn't read their brokerage accounts. And how can they do that? Well, they have every right to do that. It's what you sign when you open the account, kind of thing. And people just didn't understand. So for me, my bigger concern was the lack of knowledge. And then we have this double standard with, regulatory frameworks. We just had the SEC reduce what is called the accredited investor rule, so that more people could be in some really complex stuff. And then at the same time that they're making it easier for the everyday person to invest in complex securities, this happens, and then what's the knee-jerk reaction from there?
Thank you, Shana. And I'd like to pick up on the regulation idea in 1 minute. Before I do so, I'm coming back to dig a bit deeper into the dynamics of the events that occurred. And when Tallis said his fun fact is brewing beer, I thought that's a perfect hook now for me to combine this thing. Is any of the events that we saw related to probably people sitting at home? Is this a pandemic phenomenon? Is this a working from home or not working from home phenomenon? I want to relate to an experience I had on Facebook in March of last year when this isolation started. A friend of mine posted, being self-isolated for the past 8 days makes our house feel like Vegas. Losing money by the minute, cocktails served any time, and we don't know what time it is. So of course, I had to laugh reading that, but I thought perhaps this translates to a bigger picture where people are willing to gamble. And I know that Tallis has done some work on that. Tallis, if you were to pick up this ball and tell us a bit about your research that pertains to this idea that given that we have the retail investor at work here in these dynamics or in these events, what is gambling? What is the notion of gambling and the importance of gambling in this event series?
Sure. I think gambling and the pandemic do play a role in this. I think there's multiple drivers of this retail revolution, the rise in retail trading that we're seeing at the moment. One is, cheap brokerage, Robinhood with zero fees. Another one is social media and those platforms where people can communicate and form communities of friends and they feel part of a group and we're all trading together. But then the other aspects that come to the table are that during the pandemic, people felt isolated. Many people lost their jobs, they're unemployed. People felt lonely, people felt anxiety. In these types of conditions, we know from gambling research that people have an increased propensity to gamble under those types of conditions. The second factor that was going on is the typical places where people would go to gamble, sporting events, online gambling, casinos, pokies, these types of places were shut. And so you couldn't go to the traditional venues to do what you wanted in terms of gambling. And so the stock market was a natural place to go. So some of the research that we've done on this issue took a broader global perspective and studied gambling across multiple countries and stock markets and casinos together. And what we found was when regulators shut down casinos in a given country, controlling for all other factors, stock market volumes go up. A direct spillover from casinos into stock markets. So I think that's one of the contributing factors to what we're seeing at the moment, but it's not the only one. So I think once we're over COVID, people go back to more or less normal ways of living. I think some of that gambling propensity will subside, but there'll still be probably a slightly heightened level of retail trading because of low brokerage costs and social media platforms where people feel part of a community.
And I just want to point out, I don't think it's an accident that the poster child and the person who's coming out as sort of the head of the Wall Street Bets Reddit crowd is David Portnoy, who is the founder of Barstool Sports, who once the pandemic hit, he was very vocal about the fact that since he couldn't bet on sports anymore, he was going to start being a trader in the stock market, and he was super out there about it. So to Tallis' point, the poster child for this entire movement is exactly what he's explaining. Somebody who was bored, had no other and nothing else to gamble on, and just decided, well, the stock market seems like a good place to do it. And the difference, of course, is David Portnoy is a billionaire who sold his company for billions of dollars, but he is very much in every Joe and from the Boston area, so I'm very familiar with him, and so he's come to sort of represent this entire movement.
Thank you, Shana, and Tallis. Super exciting to learn about the gambling dynamics, a social change, an externality of COVID in financial markets that we shall watch and see continue. Carrie, I'm playing to Melbourne. Australians like to gamble in general. When I came to Australia the first time in 2008, I saw all these bars with pokie machines, and it's a very common thing to do in Australia. Have you observed from the distance that clients of yours were more hungry for a more risky investment style? Don't want to call it gambling, but it goes in that direction.
Yeah. Unfortunately, gambling and betting are not words you want to use when you think about investing and trading. They're kind of the other things. But I think it's absolutely right. There's in economic terms, you think about the scarcity of substitutes. Like there was just nothing else to do, so people were like obviously jumping online and looking at some companies they could invest in as a bit of a play. And if anyone follows that Twitter account of David Portnoy, will actually see him in the activity he takes. But it's more also about a couple of other factors. I think there's definitely a generational shift that younger people want to be involved in investing. And you've actually seen the decline in a certain 35 to 55-year age group out to 2017 really relates quite remarkably to how the stock market has done. That actually started to reverse that trend. That's a growing cohort in the age group now. And that's a cohort of people who are going to continue to invest in this way. So that's why we think this retail phenomenon will continue. And then there's also the government, the fiscal effect. I mean, this thing peaked in January. What did the US government do in December? They gave everyone $600. What have they just done? They've given everyone $1,400 checks in the mail. Some portion of that will go into the stock market. And there was a great chart that I saw by another US bank put out last week that basically surveyed its members and said, what are you going to do with your money? And a big chunk of them said, we're going to put it into the equity market. So these are the kind of things that I think have added to it, but it's definitely a longer term theme. And it's definitely becoming more prevalent in Australia. To your point, we have more of these online platforms that are coming through, like there's Superhero, there's Stake, which allows you to buy in US companies, which are all doing it at very low cost, and they are growing. There was a note in today's Aussie Financial Review that highlighted some research from Investment Trends magazine that said there'd been an extra 400,000 accounts opened on these platforms in the last 12 months. So there's definitely growth and appetite for this kind of investing here in Australia.
And Kerry, is this a threat to, say, Australia? I mean, you know this market best. Is there something at the horizon that threatens us in terms of, for example, our retirement funds that are thoroughly invested? However, we have these gamble stocks popping up, and people start gambling in markets as if they go to the pub and throw money into a slot machine.
No, I don't think there is a huge risk. It comes back to some of the points Jeremy was making about how these large institutions actually invest and the effect it has on them. And also the fact that you're talking about stocks that have a very, very small share of the equity market are not really going to move things too greatly, even if they do get a huge amount of focus in the news. I think where it could start to matter more and more, though, is just thinking about, again, that regulatory angle, what happens to the pushback and if there's changes on that thing. And most importantly, in the Australian case, and what differs to what we see in the US, is the use of derivatives. Obviously, that was a very important point, as Jeremy talked about earlier, but it's just not something you can do here in Australia. You have to outright buy the stocks. You don't have that risky exposure. You're not worrying hedge fund gammers and covering those shorts. It's not something that's quite prevalent here yet.
Yeah.
Sorry, Jeremy.
I just said yet.
Yeah. So thanks, Kerry. I would like us all to be on the right side of history, and therefore, there are some presidents in the world that use the word or the expression fake news. And I want to just get to some points that probably have gotten stuck in people's minds. And there's actually an audience question that I want to put on the table that perhaps some of you have a view on that pertains to this kind of problem. One of our audience members says, do you believe what Robinhood did by halting the buy for GME was a correct thing to do? In Australia, we had some issues with Stake and IG markets. So
I would absolutely love to take this one because I spent a lot of time preparing. There's two important aspects of this. What Robinhood did was not a choice. Regulatory requirements made them. And most people don't understand that. So, I'll try to simplify this as best I can. But when people were opening accounts on Robinhood, they were opening margin accounts. And when you open a margin account, what that means is that you are basically, when you buy a stock, you don't own it outright. You basically have the right to the shares, but Robinhood owns it. And all trading in the United States is done through clearing, right? So there's somebody who sits in the middle and the buyers and the sellers are anonymous, and they take the order from the buyer and they take the other side of the seller and they, basically clear the trade. They exchange the money and they take on some risk, right? So they give, because settlement in the United States is T+2, meaning 2 days after trade. And when this clearinghouse helps clear the trade, both parties on either side get paid immediately. So they're taking on some risk of the settlement. And subsequently, what happens is that they require the counterparties, each person on each side of the trade, to have collateral. And in this case, Robinhood was required to maintain collateral to show that they would be capable of paying for the shares after T+2. But Robinhood, you know, to the Robinhood client, they own everything instantly. They see it in their account instantly. So there's this complicated regulatory framework in which this counterparty risk is occurring. So what happens is when Robinhood had more and more exposure to a stock that was considered highly volatile and risky, and I believe the number was at one point, the belief was that 30% or more of all trading that was occurring on the Robinhood platform was occurring in GME. It made to the clearinghouse that they were a higher risk, which meant they had to give them more collateral in order to execute every trade. And, you know, all brokerage firms keep cash on hand in order to meet these collateral requirements with the clearinghouse. It's just the cost of doing business. But when all of a sudden you have this very concentrated risk and you're required to put up more collateral, there becomes a point, almost like the short sellers, right? The short sellers have to close the position once they run out of cash, where they were not able to have enough cash on hand in order to meet the collateral requirements to continue to be able to execute the trades in GameStop. So they had to get infused with cash by some of their investors to be able to meet that requirement. And then they could reduce the amount of collateral that they would have to give if they restricted the trading in these highly volatile stocks, therefore limiting their exposure to the risk for the counterparty. So it is a regulatory framework that caused Robinhood, in order to basically stay in business, right? Because the opposite was they had no cash, and so they had to liquidate everything and shut everything down, and then everybody loses. So from a regulatory perspective, for them to be able to continue to do business, these were the things they had to do. And it would have been the case with any stock in any firm when they had such concentrated risk exposure to a very volatile, very low flow, low liquidity stock in order to meet the regulatory capital requirements of the overnight lending that was occurring through the clearinghouse. And I know that's a little complex. I've actually tried to simplify that significantly. But yes, what Robinhood did was not because they made the choice. They weren't trying to hurt their customers. If anything, they were doing what they needed to do to protect all of their customers, not just those who were trading in GME. And they were required to do it for regulatory reasons, which is why someone like me gets concerned when now you're talking about increasing regulatory oversight on these things, because the regulatory oversight that exists worked, and it helped limit the risk and the exposure here.
It's especially entertaining that our own Congress people don't seem to understand that, and they talk about Robinhood did was wrong and all that. I really enjoy that. It's great. We obviously.
For that reason, I actually enjoyed watching C-SPAN that week, listening to Griffin explain the regulatory framework and listening to the CEO of Robinhood explain, like, we didn't do anything wrong. We did exactly what we're supposed to do.
What you told us we had to do.
Yeah, so you told us to do it. We weren't doing anything else.
Thank you for that, for those explanations, and also for the US perspective. Allow me to double check with Thales as he works with data. We busted the myth, Thales. Do you agree with what was said, so we can move on and understand it was not dodgy what happened in terms of the shutdown or the halting?
Yeah, absolutely. There's no conspiracy theory here. It was regulatory requirements for capital to minimize clearing and settlement risks.
Brilliant. So fake news identified and therefore busted. Thank you. Certainly I would like to.
Another fake news myth. I don't know if anybody's asked a question about order flow, selling order flow, but I'd love to. I know Jeremy and I would love to.
You've obviously got thoughts.
Well.
So actually, there's a question on here, actually, guys. In the Q&A.
And Jeremy, if you want to pick up that question right away, then you could probably take it away because I have my eye on it. But I'm also.
Well, you know, Citadel was on both sides of this stuff. They're trading so quickly that there's not. I don't think the payment for order flow is necessarily the problem here. Although you do need to think, right? If you're not paying anything to trade, right? They still have to make money somewhere, right? Right. Anyway,
and that's actually an important thing. The reason why we've seen trading get faster, more efficient, and cheaper is because of these high frequency trading firms like Citadel who pay for order flow, and they make like half a penny on the spread that they help execute the trade. But by doing that, they can make it possible for you to trade without paying a commission, and for trading to be faster, more efficient, and that for the bid-ask spreads to tighten. And all of those things are actually good for market participants. And also keep in mind, a firm like Citadel might be on both sides, just like a firm like Fidelity could be on both sides. Now, Fidelity is not seen as evil because they're not a hedge fund, but Fidelity too has a side, an asset management, investment management side, where they have people trading in stocks and sometimes even shorting in stocks. They have long short funds, just like Citadel. It's a very important understanding that the regulatory framework here in the United States requires firewalls between these businesses. So, you know, the brokerage side and the market making side of Citadel is completely firewalled, and compliance is very involved in this from the asset management side, the hedge fund side, who are on the other side of the bet. You know, it does look like a conflict of interest, but there is very much regulatory requirements in which these two sides of the business can, in some cases, not even be in the same building. I know when I worked at Fidelity, like, there were people who weren't allowed to come onto our floors because of this conflict that could occur. These firewalls are really necessary and part of the business when you have these really complex firms. So while Citadel was on both sides of the trade and did benefit on both sides of the trade, it's not like they knew everything that was going on. And the payment for order flow is actually a really important innovation in markets to help make investing and trading cheaper, more efficient, and faster.
Thank you, Shana. And I want to just quickly inject here the idea, because we had a couple of questions that we're now trying to get to. In regards to Robinhood's obligations to cease trading, should there have been greater transparency? And I'm probably asking to start with Thales, because we talked about short selling and disclosing short selling to the exchanges, and who knows about this. Obviously, one can gang up against a firm that is short if one knows how big the short is and who's in the market. Thales, could you tell us a bit about more about transparency and the desire to have more transparency when it comes to these issues?
The transparency is an interesting thing in markets, that too much transparency actually can be harmful in some settings, that switching the lights off on part of the trading can be useful in limited quantities. One of the things that is happening with payment for order flow is that makes this issue complex, is that is liquidity that cannot be accessed by most of the market. That retail flow that goes to the high frequency trading firms then doesn't hit the lit or the transparent markets. So in a sense, it is non-transparent. It makes trading volume appear large, but the actual accessible liquidity to someone that isn't a high frequency market maker is much less than that. So here's where I want to make sort of a quick point about the irony that's involved in this so-called democratization of finance, that a lot of the retail traders view this as a movement of, we're going to stick it to the Wall Street firms. And this is our way of putting power to the people. We're going to take our money back, and we're going to now profit instead of the hedge funds and the high frequency firms profiting. But who's actually the winner here in this rise of retail trading? It's high frequency trading firms and it's hedge funds. Hedge funds may have been burnt once on their initial short positions in GME, but hedge funds need uninformed traders in markets to be able to profit. A market that's entirely made up of hedge funds will in fact fail. So they're going to be profiting at the expense of the retail traders. Retail traders appear from their perspective that they're getting free brokerage, but because of the payment for order flow, actually they're paying the bid-ask spread effectively on their trades, and that bid-ask spread is being captured by high-frequency trading firms. So Wall Street is absolutely loving this, and that's the sort of the ironic part about democratization of finance. It's actually doing the exact opposite of what retail traders think that they're achieving here.
I would encourage anybody who wants to learn more about high-frequency trading to look at the book Flash Boys, which is by, is it Michael Lewis? He wrote, the entire book is about the development and the rise of high frequency trading within the markets, and it's a great book. So I encourage anybody who wants to learn more. That's a great book to look into. Thank
you, Shana. Thank you very much. And we have a few questions. I want to throw back to Carrie in the Australian context. Can GME happen here? And if so, what Thales just said seems pretty desperate to those who are the non-smart money, the small people in the market. Carrie, what is the likelihood of GME happening here? I'm not sure if the person that asked this is planning on starting to buy or something, but I'll put the question to you.
Maybe the person asking it's going to start their own Reddit forum to try and, prop a stock up. But it could happen here. I mean, you could have, one stock that gets highlighted quite heavily and it gets picked up on, and, a very small name. And, even the sort of large cap stocks are small cap stocks in the US context in Australia. So there is that potential given the thinness and liquidity in some markets. However, the realm of this online trading is still growing here. It's still relatively quite small. I mean, we do have a few more platforms where you're having virtually free trading going through. It's still a small cost. Some of them charging you $5 a trade. It's not free yet. But I think the risk here is that if you're on the retail side and you are that sort of uninformed money and you're not paying anything for these trades, you've got to ask yourself, how are they making money? Is it the payment order flow? In the case of stake, you're transferring your dollars, Aussie dollars into US dollars. They're making money on the exchange rate from you. It's about how these guys are making money, and that's where the real risk, I think, for the investor lies, is like, what are they actually getting when they go into it? So the potential for a Reddit kind of GME stock in Australia is there, I guess, but it's pretty limited given the dominance of institutional investors here and the still quite small scale of how retail money works here, rather through mutual funds and direct stocks, I believe.
And do you think, Carrie, I'm sticking with you, do you think market participants have learned from this event? So as soon as something is just about to occur in Australia and we see a small rise, will people be warned and smart money will be immediately taken advantage of that, you reckon? In addition to the knowledge probably that existed before, is there a learning effect in the market?
Well, I think there's a big thing here about investor education, about what they're actually doing. I mean, Shannon talked about companies or people who had done the research on GME and either thought it was a good or a bad company. There's a difference between actually doing that fundamental research on an analysis on a company and deciding whether you want to invest, or just going with the flow and the momentum of the markets. And there's always going to be people who do that, but they're probably going to be the ones that lose because they're not going to time when to get in and out very well. Whereas the fundamental investor, the one with perhaps a longer time frame, is actually going to be the one that sticks with it and makes the money. So for us, I mean, there's trading. We tend to think about investing more often. And I think that investment horizon is really what matters. Sure, people are going to take a little bit of money and maybe trade a little bit more on a short-term basis as something to do and build up a skill set. But I think there'll be definitely a surge in investor education about what's actually happening in markets and how to actually approach it, learning from what we saw in the US.
Thank you, Carrie. And I'm now going to pick a few questions that come like out different parts of the topics here, but allow me to point those at you because we have only a few minutes left. Someone said, Thales, your definition of gambling, if I buy a GME today and sell it tomorrow, does that make me a gambler? I think there's some upsetness about probably being categorized as a gambler, since I've met a lot of people that are now trading coins and other stuff. Are those people all gamblers, Thales, or what is your definition?
So there's a class of stocks in markets that empirically, for the purpose of research, we've defined as lottery-like stocks. And what makes a lottery-like stock is if a stock has features very similar to going out and buying a lottery ticket, which is a small probability of a very large gain. Okay, but that usually comes with a flip side, which is a reasonably large probability of making a loss. Some of these stocks will have negative expected returns, but people that go in there willing to take that bet of I'm probably going to lose my money, but there's a small chance that I'll make 10 times my money. That's very similar to what happens when someone goes out and buys a lottery ticket. So that's how empirically we distinguish or isolate these lottery-like stocks. It's based on the distribution of returns that one can expect. But from a more sort of philosophical standpoint, I think investing is when you're trying to maximize the long-term value of your wealth and maybe put some constraints on the amount of risk that you're willing to take in that process. Whereas speculation or gambling is looking for a very quick and easy short-term gain.
Thank you, Thales. And I'll follow up with a question that I shoot to Jeremy because he's in the US. Have these these platforms, have they gamified the trading experience seemingly without proper education? Is that part of the problem that?
I personally, I think that more investor education is pretty much always better. I think it's really hard but I think it's hard to say that that that's a problem necessarily with the market. I think that investor education is something that should happen. I think that these investors, I think what's going to happen is I think there's going to be some kind of increased regulation where they have to pass like a minimal competency exam or something like that. I think that's one of the things that's been discussed already, and I think that might happen like before they can, trade for themselves, especially before they can trade derivative instruments, right? I think that's at least in the realm of likelihood, and enough that I would talk about it here. So there you go.
Interesting, Jeremy. When I drive a car, I need a driver's license. Carrie, I'm playing with you one more time. Do we need licenses for people to operate? Licenses as in retail investors need to take a course or prove that they are allowed to play with a smaller stock? Question one. And the second one is, are we in Australia behind because trading is still too expensive compared to what we see from the States?
Well, take the first question first. Yeah, you can drive a car without a license, but you're more likely to crash. That's the way I would put it. You don't know the rules of the road, so you're going to do something wrong and get a ticket. So it's the same with investing, right? If you don't know the rules, if you don't know what the regulations are and you get upset, or you don't know the basic principles of investing, you're more likely to lose out. So whether it's a mandated thing you have to do it, or whether it's simply people should be doing it for their own benefit, I think that it's well worth investing that time in if you are going to think about growing wealth and growing your portfolio over time. The second one around, are we behind in Australia? Obviously, we've had a very dominant financial industry by a few very large players. That is starting to change. I think the pace at which fintech is moving here is really picking up, and you will see that dynamic definitely change and become more open. The flip side of that is that, in the case of the US, you've seen some of these large players in the financial industry already start to partner with some tech stocks and have their own sort of fintech shoe-offs. You might see that in Australia as well. So you might see more fragmentation here in terms of fintech development, but again, it won't take long for those big players to start sort of pushing out and jumping back into the market with their own kind of products in this realm. I mean, absolutely, investing here on a stock-by-stock basis is quite expensive compared to the rest of the world, but that is changing slowly.
Thank you, Kerry. And I probably want to close, we have a minute left, with a comment of yours to try to be a bit empathetic for those that gambled and or partook in the market, have partaken in the market, and probably lost a lot of money and probably sit on debt now. I mean, there must be some people that as Tal has explained, like played the game with the hedge funds and eventually probably now face a mountain of debt or at least a loss of personal wealth. That bears the question, do we need to protect those people that are probably overconfident, that are probably suffering from their view that they're good at rolling the dice in markets? Is that something we need to protect people from ASAP? Otherwise we see like personal dramas panning out, question mark? And I know we're playing two systems here, and Shana will help me with the US system. And of course, in Australia, it's probably a bit different, but I'm interested in that because protecting people from doing harm to them and their families is certainly in the interest of society. Shana.
I'll just start by saying, if you want to live in a free society, then you can't expect people to protect you from your own mistakes. And I firmly believe that. Like, if you chose to play in this and you lost money, and a lot of people who did play in this Reddit thing, were willing to lose everything, and even if they couldn't afford to, because they want to stick it to the man. And I think that that's playing and leveraging on underlying social issues. But I also think that who's going to protect you? Because we already know our government doesn't understand this stuff, right? So you want them to protect you? You want the people on Wall Street to protect you? No, like our job, that's not our job. Our job is to make money for our clients and to do the right thing for our clients. And if you want us to protect you, then you should hire us, right? That's the point.
Jeremy.
And so I just think that, if you want to live in a free society, then you have to take some responsibility for your mistakes. And if you make that mistake, that's on you. It's not anybody else's job to protect you.
Thank you, Shana.
Completely, I'm clapping because I agree, Gerhard. I completely agree with what Shana said. So, yeah.
So two Land of the Free members here that clearly are for free decision-making and free markets in that sense. Can I ask my Australian partakers here, Kerry and Talis, what are your views on perhaps providing protection to the public, yes or no?
Well, I think some of it might come down to your which way you lean politically in terms of how much you think the government should be involved in bailing people out should they lose too much money. Certainly I have colleagues who would think more liberally, and those would be more conservative about what it should come through. For me, it's kind of like, if you barbecue in your backyard, you might burn your house down, so you have house insurance. I mean, it's the same principle. There's a risk something could go wrong, so you get insurance, whether that insurance is having a better knowledge of what you're doing, or to use a firm that can help you invest with those, or a financial advisor. It's all about just making the necessary steps that you don't lose the shirt off your back. And I think that perhaps that lesson has been learned by some people, unfortunately, in this incident, but they also might gain from that in the future.
Thank you, Kerry. Talis, if you want to close this discussion by providing us your view, probably a data-driven view.
Sure. I'd say, in addition to what you flagged as people being financially ruined, at least some people being financially ruined, it also goes a little bit beyond that to mental health issues, family breakdowns. There's been a suicide in the US for someone that was trading on Robinhood that didn't realize the amount of risk they were taking, or misinterpreted the numbers that were showing up in the screen as potentially having made a loss. I also know someone personally that on the stock market went from $1 million in their self-managed superannuation fund down to $20,000 now is the balance. Just through churning stocks, it took 4 years to churn down to that. And what are they now? Falling back on the social safety net that's provided by the government. They're on the government pension, sucking up basically taxpayer money as a result of these types of issues. That said, I'm for people making informed decisions, and being, as long as they're not harming others, and if they're informed about what it is that they're doing, and if they want to do it to themselves, fine. I don't think the government should prevent people from doing it, but I think that there should be at least a basic level of disclosure about, the retail trader track record, that the more you trade, in fact, what the evidence shows, the more retail traders trade, the more they underperform the market because of chewing away their wealth in trading costs. The fact that when you invest in active funds, the best predictor of how much you'll underperform is the fee that they charge. So these kind of basic facts about investing based on the empirical track record, I think, should be disclosed to investors, and then let them make their own decisions about how they want to control their own financial destiny.
Thank you very much, Talis. And unfortunately, we have reached the end of our available time. The UTS Finance Department would like to thank you, the audience, for having attended today's event. And please do not be a stranger, and find and follow us on LinkedIn, Twitter, and on Facebook. A big thank you to our panelists who have shared their valuable time and experience with us. We are very grateful for your contribution, and we look forward to welcoming you back at a future event. Please visit us again on 26 March at 12:15 p.m. to enjoy some fresh finance research presented to you in a fast-paced 5 minutes format. And I'm also inviting, of course, my American friends, as the time difference seems to work out well. Until then, I would like everybody to be safe, and we wish you a great weekend. Have a great rest of the day, and good night to America. We'll see you soon. Bye-bye.